This video is Chapter 8, Question 1. We will be looking at different types of inventory cost flow methods. Here we'll be looking at the perpetual system and how to solve with LIFO and average cost methods. In front of us we have different transactions throughout the month of August that we'll look at in more detail on the following slides. The problem requires us to determine the inventory balance Elvira would report in its August 31st year 1 balance sheet and the cost of goods sold it would report in its August year 1 income statement using the following cost flow methods, which is last in first out or LIFO and the average cost method. So here I have a table for the LIFO method, which we'll do first, and we track the date of each transaction, whether it was a purchase, whether it was sold, and the end balance of inventory at that time. And with the perpetual system, which is the type of problems we're doing right now, you constantly update the inventory count after a purchase or sale, rather versus a periodic inventory system where you do it at the end of a period, for example, at the end of August. So let's look at the first transaction here. On August 1st, tells us our inventory on hand is 2,000 units and they cost $6.10. So we'll plug that in under the purchase section. 2,000 units times $6.10, which gives us $12,200. So that will be our balance. Over here as well, there's 2,000 units. It costs $6.10, $12,200. Moving on to our next transaction, we have August 8th. They purchased 10,000 units for $5.50 each. So we'll plug that in, 10,000 units for purchase at $5.50 a piece. So the total amount there is $55,000. We again come to our end balance. We know the first one. We have 2,000 units that cost $6.10, $12,200 total. Now we also have 10,000 more units that cost $5.50 each, $55,000. So our current inventory total is $67,200. Our third transaction, August 14th, sold 8,000 units for $12 each. So we're going to put that in this box here, and this is where the LIFO method really comes into play. So we want to know what the cost of goods sold were for the 8,000 units. So we're not going to use this $12 that we sold it for. We want to know what we paid for it when we got it. And under LIFO, last in, first out, we're going to look at the last 8,000 units we purchased and use the cost associated with that. So if we look up here, the last purchase, the last 8,000 would come out of this last 10,000 we purchased at $5.50 a piece. So we would fill the box in as 8,000 units sold at a cost of $5.50 a piece. It's going to equal $44,000. So now we update our inventory. We still have the 2,000 from our first, or at the beginning, 12,200. We've taken away 8,000 from the last 10,000 we bought, so there's only 2,000 left, and we paid $5.50 for those. So that's going to give us 11,000. So adding that together, our new inventory balance is $23,200. Let's move to our fourth transaction, August 18th. We purchased 6,000 units for $5 each. We need to update that in the purchase column with our 6,000 times $5 a piece. It's going to equal 30,000 in total purchase. So we take our 2,000 units from the beginning, we take the 2,000 units that we had left after our first sale. And now we add on our most recent purchases, 6,000 units times $5, which equals 30,000. So we add all that together to get our total inventory amount. That's 53,200. Now we look at our next transaction, August 25th. They sold 7,000 units for $11 each. So we have 7,000 units sold. So let's look. We recently purchased 6,000 at $5, so we'll use all those up, but then we still have 1,000 more that we sold, so that will come from this amount. So we'll have sold 6,000 that cost us $5 and 1,000 that cost us $5.50. It looks like this. So we take 6,000 units, multiply by $5, gives us 30,000. We take 1,000 units from the next most recent purchase, cost us $5.50, which will equal 5,500. Then we come over and we update our balance one more time. We have 2,000 units at $6.10 for 12,200. We have 1,000 units at $5.50, which equals 5,500. So this will tell us our ending inventory of 17,700. It's our end inventory. And then over here, if we add up all our sales, so this will tell us our cost of goods sold. Because we sold 8,000, the cost was $5.50 for a total of 44,000. And then down here, the two sales we just had. If we add these three together, that will give us our total cost of goods sold. So total cost of goods sold equals 79,500. So this is what we would report on our income statement for cost of goods sold at the end of August, and this is what we would report for inventory on our balance sheet at the end of August as well. Here we will again solve for ending inventory as well as cost of goods sold. The difference this time being that we will use the average cost method. So let's look at our first transaction again. Inventory on hand, 2,000 units, cost $6.10. So we will plug that in just like we did last time. 2,000 units, $6.10 gives us 12,200. That is also what our ending inventory is going to be at this date. We look at our August 8th transaction. We purchased 10,000 units for $5.50 each. Again, that's just like the last problem we did. 10,000 units times $5.50 equals 55,000. So now we see our August 14th transaction. We're going to be selling 8,000 units for $12 each. So to figure out what the cost of these 8,000 units are, this is where the average cost method comes into play. So we're going to take the dollar amount of all the units that we've purchased divided by the actual number of units we purchased. So we take 55,000 plus 12,200, which gives us 67,200. We divide that by the total units we purchased to date, which is 12,000. That gives us our average cost per unit at $5.60. So now, on the August 14th transaction where we sold 8,000 units, we multiply by the average unit cost number, $5.60. That gives us 44,800. That's the amount sold. So now, to figure out how many units we have left, we simply take the 12,000 total units we had, subtract the 8,000 we sold, so we have 4,000 units left, and we then multiply that by the average cost, of $5.60. That will give us $22,400. Moving down the line to our August 18th transaction, we purchased 6,000 units for $5 each. So we write in that transaction 6,000 times $5 gives us $30,000. Let's again find the average cost. So at this point, we take the 30,000 and we add it to what we have left in ending inventory before that, which gets us 52,400 as the total amount we have in dollars. Divide by the total number of units. We just purchased 6,000 and we already had 4,000 on hand, so a total of 10,000. That will give us our average cost of $5.24. August 25th, we sold 7,000 units. We multiply that by the average cost. That's going to give us 36,680. So we sold 7,000. We had 10,000. We have 3,000 units left on hand. Multiply that by the final average cost of $5.24 to give us an ending inventory amount of $15,720. That is our end inventory. For cost of goods sold, we're going to add the 44,800 up here plus the 36,680. That gives us a total cost of goods sold amount. And it's 81,480. So that is what we will report using the average cost method as our cost of goods sold on the income statement, and this is our inventory dollar amount that we will report on our balance sheet at the end of August.